You just got your first paycheck, or maybe a Diwali bonus finally hit your account, or a fixed deposit matured. You know you need to invest it to build wealth, but instead of taking action, you freeze. You're terrified of making the wrong move and losing your hard-earned cash. The confusion usually comes down to the noise around two options. Half your friends tell you to drop the whole amount in at once. The other half insists you should drip feed it into the market slowly over time. Finding the right answer actually has very little to do with predicting where the stock market is heading. It starts by looking at exactly where your money is coming from. Earning a predictable monthly salary is a completely different reality than sitting on a sudden large windfall. Those two situations require completely different approaches to entering the market. Selecting an SIP or a lump sum is a way to align your entry strategy with your personal risk tolerance, prioritizing steady behavior over a mathematical race for the highest possible return. An SIP is essentially a monthly subscription for your wealth. You set a fixed amount, and it automatically gets invested into a mutual fund on a specific date every single month. The barrier to entry is extremely low. If you're a beginner in India, you can start an SIP on most platforms with as little as 100 to 500 rupees a month. A lump sum investment is the exact opposite. You take a large, one-time amount of capital and deploy all of it into a mutual fund in a single transaction. One is a continuous, automated drip. The other is a single, heavy drop that usually requires a minimum of 1,000 rupees and often involves much larger amounts. Both methods buy into the exact same mutual funds. The difference is how they expose your cash to the daily ups and downs of the market. For a beginner, the SIP relies on a mechanical advantage called Rupee cost averaging. This chart illustrates market volatility as a wave. Because your SIP is automated, it executes on the exact same day every month, no matter where the market happens to be on this curve. When the market is high and expensive, your fixed 1,000 rupees automatically buys fewer units of the mutual fund. But when the market dips or outright crashes, that exact same 1,000 rupees scoops up a much larger number of units at a heavy discount. Over time, this natural averaging means your overall cost per unit drops. More importantly, it removes the pressure of watching the news and trying to guess the perfect day to buy. The trade-off is that this requires patience. You are drip feeding your capital, which means you won't see massive overnight spikes in the portfolio. You have to be consistent over years. That makes stopping your SIP during a market crash the most destructive mistake you can make. A crash is precisely when the mathematical advantage of an SIP is working hardest for you. Automation removes the emotional stress from the process. It converts market drops into buying opportunities by default, requiring no manual intervention or decision-making from you. Then there is the lump sum strategy, where you take a large corpus of cash and put it to work in one massive move. Mathematically, if you successfully drop a lump sum at a market low, you maximize your capital's time in the market. That leads to powerful long-term compounding. The trade-off here is immediate and intense. 100% of your capital is immediately exposed to short-term market volatility. If the market drops suddenly the week after you make a lump sum investment, your entire portfolio takes a direct, highly visible hit.
The psychological toll of watching a 2 lakh bonus shrink in days is severe. Recovering from a poorly timed entry is possible, but it requires a long time horizon. You have to be willing to leave that money untouched for at least 5 to 7 years. While a lump sum can mathematically outperform during a continuous bull run, it demands a level of risk tolerance and timing luck that very few beginners actually possess. So what happens if you receive a huge inheritance or a mature fixed deposit, but you're terrified of dropping it all into the market right before a sudden crash? This is where the Systematic Transfer Plan, or STP, comes in as a hybrid solution. An STP is simply a mechanism for moving money from a safe zone into a growth zone over time. First, you park your entire windfall into a low-risk liquid fund. This ensures your money immediately starts earning a baseline interest rate instead of sitting idle in a savings account. Then, you automate a monthly transfer of a fixed slice from that safe liquid fund over to a volatile equity fund. You get the psychological armor of Rupee cost averaging while ensuring your large windfall is actively working for you from day one. There is one final layer of evaluation you need to consider for 2026, What happens when it is time to withdraw the money and the tax implications kick in? In India, equity mutual funds are subject to capital gains tax. Short-term capital gains are taxed at 20% for units held less than a year. Long-term capital gains are taxed at 12.5% for units held over a year, above a 1.25 lakh threshold. Lump sums are incredibly easy to track for taxes. You have one single purchase date, which means you have one clean, simple one-year countdown for the entire portfolio. SIPs have a hidden administrative complexity. The government treats every single monthly installment as its own separate investment, with its own independent purchase date. If you withdraw an entire SIP portfolio today, the earliest months will qualify for the favorable long-term tax rate. But the installments you made in the last 11 months will get hit with the heavy 20% short-term tax. While SIPs are drastically simpler to start and manage behaviorally, lump sums are actually much simpler to track for tax purposes when it is finally time to cash out. The ultimate reality check is this: overthinking and waiting for the perfect market crash is mathematically worse than picking an imperfect strategy and starting today. This chart maps your two most important variables. Your final decision rests entirely on crossing your available capital with your emotional tolerance for risk. If you are a salaried beginner with a predictable income, but you feel anxious about market drops, you belong in this quadrant. Your directive is clear. Choose an SIP. Start with whatever you can afford from your paycheck, automate the deduction, and swear to never pause it when the market bleeds red. If you received a sudden, large amount of cash, but the thought of a market crash keeps you awake, you belong here. Your directive is the STP. Protect your wealth by parking it in a liquid fund, then drip feed it systematically. If you have a large corpus, understand markets, and can stomach a sudden drop without panicking, you are the confident optimizer. Your choice is lump sum. Deploy capital during a notable market correction, provided you have a 5 to 7 year horizon. Personal finance is deeply personal. Identify which of these 3 quadrants you live in today. Lock in that specific strategy, and let compounding do the rest.